So as we start chapter 9, we're actually getting into the second part of the book, which is why this says part 2. Everything we're going to do from chapter 9 forward this semester is going to be dealing with a merchandising business that's organized as a corporation. So the first thing that I want to do is go into our Cengage account, and we're going to look here at the business 3 Green. So 3 Green is a business that's we're going to use. It's a retail merchandising business organized as a corporation. Basically, they rent store space in a shopping center like you would at Independent Center or any other mall, and they buy stuff to put into their store to sell to other people. So let's listen to the owner here talk about her business.
Hi, I'm Mary Griffith, owner of 3 Green Incorporated. I've always been passionate about environmental issues and preserving the world around us. So when I bought my own home, I wanted to be sure to use the most eco-friendly products. It wasn't easy to find them. I spent hours on the internet searching for organic and recycled products and found I had to buy them from multiple retailers. It was frustrating. So I had an idea to open my own store, a one-stop shop for the environmentally conscious consumer. I purchase environmentally safe products directly from manufacturers and resell them. I offer a wide range of products, reusable shopping bags, stainless steel water bottles, organic cleaning products, and items such as clothing and linen made from recyclable materials. I raised capital from a small group of investors and opened a store in a local mall. Each investor owns a share of the business. I plan to be around for a long time, and I hope to pass on my shares of the business on to my children someday.
Okay, so the next thing I want to do is look at the chart of accounts, because our chart of accounts for a corporation is a little bit bigger than it is for a service business. So when we scroll down, we're going to look here. We have our assets. Again, assets have to equal liabilities plus owner's equity. It's just that because we're dealing with a corporation, we have a few more assets than we do in a service business. And if you notice, they're actually divided into current assets and plant assets. That's not going to be something we're going to deal with a whole lot right now, but just so that you can be aware of that. And then we have liabilities, and we have more liabilities than we did before also, because in the service business, the only liabilities we really had were accounts payable. So you'll notice here we have one accounts payable account, and then we have other payable accounts. And we'll get into using those later on in future chapters. Then we have a stockholders equity, because a corporation is not owned by one person. It's owned by people who own stock, which we'll get into here in a few minutes. So we have a section of that. Instead of capital or drawing, we have our stockholders equity section here, which looks a little different. Then our income statement accounts. We have operating revenue. So we have a couple of different things. And we'll get into dealing with sales discount and sales returns and allowance in a later chapter. But if you think about a store, you go and buy something, sometimes you have to return them. And so that's what those accounts are for. And then we have this cost of goods sold. That is for things that we purchase that we're going to put in our store to sell. And then we have our expenses. And then we have a lot more expenses here. And then we also have another section called other revenue. And then we have these subsidiary ledgers, which we're going to talk about here in just a few minutes. But you can see we have a listing of accounts receivable, customers, and a listing of, this is supposed to say accounts payable. That's wrong on their website. But the accounts payable, which are our vendors. So to go to my PowerPoint, back to my PowerPoint here. We're going to start looking at what a merchandising business is. So first and foremost, if you're going to have a store, basically that's what we're dealing with in this, and like a retail store, you have to have stuff in that store to sell to your customers. That is called merchandise. It's goods that a business buys from a vendor, puts in their store, and sells to their customers. And of course, a business that does that is a merchandising business. We're dealing with retail mostly. A wholesale merchandising business is one that buys and resells to other merchandising businesses. They maybe buy in bulk and sell to individual stores. So for instance, you might have a wholesale business that buys tennis shoes from Nike and Adidas and Under Armour and all that, and they buy in bulk, and then they sell smaller portions of that off to stores like Shoe Carnival or Famous Footwear or things like that. And they're kind of that middleman between the creators, the Nike, the Adidas, and those kinds of things, and the store that actually sells them. We're not going to really deal with the wholesale merchandising business, but just so you understand what the difference is. So a corporation is a business that has basically the legal rights of a person, but it's a business. The assets or other financial resources are called capital. So our capital that we dealt with first semester was the owner's capital, the owner's rights to the business. Capital in a corporation is a little bit different. Anybody who owns a share of stock, which is ownership in a corporation, is a piece of ownership in a corporation, and they are called a stockholder. And the total shares of all ownership in a corporation is called capital stock. So if you have a small business and you decide that you would like to somehow have an influx of money to help grow your business, you might decide to become a corporation. And then you sell off shares of stock for a certain amount of money. And that gives an influx of some cash to help you grow your money. That's sometimes why people become corporations. So each small little piece of ownership in that business is called a share, and anybody who owns it is called a stockholder. To become a corporation, you have to file articles of incorporation, which are basically legal documents with the government that say you're a corporation. And then once you are approved through the government to have that corporation, they call it a charter. So let's talk about subsidiary ledger. So I mentioned that when I was going over the chart of accounts. In section 1, when we dealt with the service business, we had some vendors that we bought stuff from and paid at a later date. We called them accounts payable. And in that unit, we had like accounts payable dash ABC company, accounts payable dash XYZ company. Now we're going to have one account in our general ledger called accounts payable, and we're going to have a whole separate ledger for our accounts payable accounts when those are vendors. So it's somebody that we buy merchandise or supplies or other things from and pay for them at a later date. So we have a whole separate ledger, and a ledger that summarizes all of that is called a subsidiary ledger or subsidiary ledger, however you want to pronounce it. Some people call it a subledger. But the subsidiary ledger contains that list of all those accounts that you owe money to that are going to fall in your accounts payable ledger. The accounts payable in the general ledger is called a controlling account. So we now have two separate ledgers. So here's kind of a visual for you. Over here is our general ledger, and we have this account called accounts payable. Then this is a list of all of our vendors that we owe money to. And when you add all the balances of all of those people that we owe, businesses we owe money to up, that should be the balance in the controlling account in our general ledger. So all we're doing is that instead of having in our general ledger 6 different accounts payable dash whatever name and separate accounts there, we're having one accounts payable account, and then we're going to have a whole separate ledger where they each have their own account so we can keep track of what we owe each of them individually. Accounts payable is still a liability. It still has a credit balance, so it goes up with a credit and down with a debit. So our controlling accounts are going to be the same way in our subsidiary ledger. So if you look at the forms here, this is a general ledger account that we used first semester. It says accounts payable, and it would have your debit and credit and then your balance account. We used this all first semester, starting with chapter 4. The subsidiary ledger form looks a little bit different in the fact that for accounts payable, because accounts payable has a normal credit balance, we only have one balance column, because you should never have a debit balance in an accounts payable account. I guess if you overpay them by mistake or something, you might, but normally you're always just going to have a credit balance. Therefore, it only has the credit balance column. To open that up, you write the name of the vendor on the line and the account number. So let's talk about account numbers real quick here. In the first section, all of our accounts had a 3-digit account number. Now, because we're adding these subsidiary ledgers, our general ledger accounts are going to a 4-digit number. And we'll talk about that at a later date. And then our subsidiary ledgers have the 3-digit. So just like we talked about first semester, an account number of 210 tells us that this is a liability because it starts with a 2, and that 10 means it's the first account in the listing of the vendors that we owe alphabetically. And that's basically how we get started with subsidiary ledgers.